Welcome to Financial Strategies with Andrew and Daniel Adjemi, powered by the Retirement Income Store and brought to you by Adjemi Financial Strategies in Guilford, Connecticut and Denver, Colorado.
You know, AAA, something I've been thinking about and something that's stuck with me for a long time. I remember, I think we were down in Arkansas. We had this RV and we were driving up and we were visiting some of your family. And we got there and we parked in front of this little lake and we were trying to fish and start a fire or something so we could grill the fish we could catch. And me and a couple of my cousins got bored. And so we decided to go out and drive the four-wheeler around and drive around all this acreage. So we're driving around and it's getting dark and cold. And we're getting low on gas on the four-wheeler and just hungry and want to go back. And I remember asking my cousin, who we didn't see a lot. We barely saw them, and, you know, building a relationship, getting used to hanging out with them, having fun. You think the food and the fire is done back at the place? Because you guys hadn't caught any fish by the time we left. You just put in the lines and nothing was going on. And he goes, yeah, I think so. And I said, why is that? And he said, well, when we left, my dad was working on the fire. When my dad works on something, he gets it done. I'm Daniel Adjemi.
And I'm Andrew Adjemi. Welcome to this week's version of Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. Today's topic is retirement confidence. Do you have it? Working with a true income specialist can help you with that. Daniel, that's a great story to illustrate the confidence that Austin had in his father. And, you know, when we've talked about people's retirement, and we say how hope is not a retirement plan because not a lot of confidence and hope. And so, you know, that's the idea here, is the confidence that Austin had in his dad was bar none, right? He was 100% confident in him. And if people are not 100% confident in their retirement plan, that's a problem.
And what evidence, right? So first off, I guess to finish the story, he was right. When we got back, there was a fire. And there was, but he didn't have that confidence because his dad said, there's going to be a fire when you get back, right? It was right. Years of his dad showing when he worked on something, he got it done.
Right.
And so you may have confidence, but what is it based upon, right? We have to sometimes check our assumptions and see if our assumptions are based on truth or if they're just based on garbage that got pumped into the assumptions, right?
Right. There's a lot of people that will say a lot of things, and they can convince a lot of people that everything is all right. But, is that really the truth of the situation? That's another thing. That's why we have this show, is to be able to help people to understand the truth, help them to know what they don't know, right? Well, I'm glad to be able to be back this week, and we have some, this is part 2. This is Retirement Confidence Part 2. And if you just joined us, you know, what we're talking about is I'd like to do a quick recap with what we talked about on Part 1. And, we talked about the idea of how to have financial confidence, you need to be able to have somebody helping you that's a specialist that is able to listen to your needs and communicate with and be able to help kind of be the CFO of your financial portfolio to the best of their ability. Needs to be a fiduciary, somebody that's working in your best interest, not just from the aspect of what's suitable for you, but what's in your best interest, and not just what's in the best interest of the company, but what's in your best interest as the account holder. The third thing that we had talked about last time was the aspect of Social Security, required minimum distributions that you need to be able to know how to handle, how to take Social Security, how to make sure that your investments are set up to take your required minimum distribution properly, making sure that you switch from the accumulation to distribution mindset at the proper time. Then another aspect that we talked about last week was the aspect of respecting your principal, respecting the capital that you have, growing your money the old-fashioned way, organically through dividends and interest. And then the fifth point that I want to bring out is bond mutual funds versus individual bonds. And very important point, Daniel, when we're talking about that this week, I came across somebody that I explained that to, just like we did on the radio last week. And the person had not heard that before. It was new information to this analytical person with their portfolio, because they had a lot of stuff in bond funds and they were wondering why it was down. And I explained that to him. And I said, but the most egregious thing here is not the fact that you don't understand this, the fact that professionals that have been in the business for decades don't understand this. Because I've had the, I don't know if I want to say privilege, but maybe the privilege of educating financial professionals in the difference between bonds and bond funds. So, that is a huge thing. Man, time is just going by so far. Listen, if you've just tuned in to us today, or you're listening to Financial Strategies with Andrew and Daniel Adjemi, today's topic is retirement confidence. We have a paper that we put together for today's show that will be able to help you to understand and be able to give you some more information besides what we're talking about today. It's called The Dangers of Spending Down Principal During Your Retirement. Hopefully your parents taught you, don't spend principal, spend the interest, right? The dangers of spending principal during your retirement. We'd love to put that in your hand. You can have that by calling us at 800-725-7616, 800-725-7616. Daniel, it's bonds versus bond funds. We were talking before the show started today about, some of the things that you were doing yesterday with some individual bonds and some advantage, some things that you were able to take advantage of to put our clients in a better position. I was hoping that you would be able to explain that a little bit to our audience here today.
Well, going back to what you're saying in that commissioned report we're giving out, don't spend your principal, spend your interest in dividends. And this doesn't resonate with a lot of people because it's so hard. I mean, we were looking at somebody's portfolio the other day, you and I, someone who wanted a second opinion, and the income portion of their portfolio was not generating enough income to cover the fees that the management company was covering them. And it's like, so you have to spend principal, because if your income is not, if it's not generating enough income to cover their fees, that means when you want money out of the account, you have to sell principal. And then when we look at bond funds, well, bond funds are down tremendously. Yeah. Like they are setting like government bonds are setting records for how much they're down.
Wow.
Year to date. And that's where you want individual securities, individual positions that have the due diligence on them, because it gives you flexibility. What do you mean by flexibility? Well, we went over last week, and people can listen to that show, right? They could go to our website, adjemi.com, to listen to it, or search financial strategies on any of the places you listen to podcasts and get that and listen to it. But we went how those work, where you buy a contract from a company that you're going to trade them, give them the use of your money for a period of time. Maybe that's 4 years. And at the end of the 4 years, they give you your principal back. You get coupon payments in the meantime.
Interest payments.
Great. Now, you can buy these at premiums or discounts, right? So you can buy it, if you give them $10,000, you can give them you could buy these for $11,000. You'd be buying it from someone else, not the corporation, right? Another investor. You could trade that investor $11,000. That'd be a premium for 10,000 bonds. Mm-hmm. And your income stream. So let's call it $500 a year. Mm-hmm. Or you could do it at a discount. Mm-hmm. So maybe you're buying 10,000 bonds for $9,000 plus that $500
Nice.
in coupon payments or interest payments.
Right.
Okay. So if you own a bond fund, then whatever all the bonds aggregated together and the manager or the other investors who also own the fund decide happens to the bonds. So someone else in the bond fund might decide to liquidate, which means your bonds, your contracts are being liquidated too.
Right.
If you own individual bonds, and this is what you were talking about, this is what happened last week. There's bonds that we bought in people's portfolios that we bought at discounts, and now they're going to come due in about 6 months. So they're trading at par. We've collected our interest. We've actually made money because we went from a discount to even. So we made our money.
Nice.
We collected coupons. And now we have the choice. These aren't down. Like a bond fund, if you owned a bond fund, it's down. It is probably down like 20%.
Yeah.
These bonds aren't down. They're actually up. And we collected our interest payments.
Nice.
So we have the choice. We can wait till maturity or we can liquidate. So we decided to sell these and then buy new bonds that will come due maybe in 4 years, but they're paying a better coupon. They're paying better interest and we're buying them at discount. So if we're in that example, we're buying them at $9,000,
10,000,
but we're getting 10,000 bonds, right? So we're going to make $1,000 just to go back to par. Yeah. And we collect our interest payment in the meantime. This is the kinds of things you can do when you own individual positions and you know the credits backing up those payments. So you know the company, you're not just buying any company, you're buying a company that you're looking at the fundamentals and you can see that they are going to be able to make those payments to you and return your principal in whatever time period that you're purchasing those coupons for.
Wow. That's so that you're taking from the company. In your example, it's a $10,000 loan that actually they're borrowing $10,000 from you, and you as the manager of these things are looking at those, as well as some of the CFAs and other analysts that we have available to us, to make sure that these companies their credit ratings are good and that they're good to pay their bills, they're good to pay their debt, and that in your example of that 4-year period of time, we get the $10,000 back, dollars or whatever in the meantime. And if we bought that $10,000 bond for $9,000, we actually made $1,000 profit at maturity besides the $500 every year. So example, we've made $500 a year plus $1,000. So it's 4 years. So basically made $3,000 on a $10,000 investment in 4 years. Pretty nice. Wow. So you've been doing that, taking advantage of those opportunities that are out there for our clients. Thank you very much for that. And on behalf of our clients, I want to thank you for that. If you just joined us, or if you've been listening, you're listening to Financial Strategies with Daniel Adjemi, because people don't know what people don't know. Now, today's topic is retirement confidence. Do you have it? Well, we're hopefully from today's show, you're getting it, but we also want to give you this book, Retirement Income Story, by our friend David Scranton. This will be able to help you go into a little bit more depth on some of these other things, various things that we're talking about, or go into things that we're not talking about, to be able to give you confidence, to be able to make smart decisions for your retirement so that you can make sure that you have retirement confidence. You can have this book for free by calling us at 800-725-7616. 800-725-7616, or you can contact us via our website at agemy.com, agemy.com. And we'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's agemy.com. Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
So, Daniel, when you were just talking about the difference between bonds and bond funds, that reminds me of how I went to Tulsa, Oklahoma a few years ago to see my friend Greg down there. Greg's in the same, as you know, Greg's in the same business that we are. And Greg was talking to some people that come in to see him. He was doing a second opinion on their financial situation. He was explaining to them the difference between bonds and bond funds, what you just did, because most people don't understand that, let alone financial advisors. But a lot of those don't understand it, or at least they don't tell you. But anyway, the people turned to Greg and they said, Greg, if bonds are so much better than bond funds, if individual bonds are so much better than bond funds, why did our advisor put us into bond funds? And Greg turned to them and went to his whiteboard and said, well, this is why your advisor put you into bond funds. And then he wrote a big check on the board. He said, because it's easy. This is how hard it is to put your money in bond funds. Just check in a box. I'm Andrew Adjemi.
And I'm Daniel Adjemi. And you're listening to Financial Strategies. We're doing a two-parter. And today is the second part of a series we're doing to try to help investors, retirees, have confidence in their retirement plan. And if they're not sure if they have confidence or they don't have confidence, the questions to ask so they can gain that confidence, or the tools they need to make a decision to give them the confidence in their retirement. You get to do this one time, right? Retire one time.
Hopefully.
You make a mistake, you're big trouble. So it's important to spend some time. I heard a statistic the other day that people spend more time doing research on a new dishwasher or clothes dryer than they do on research on the money or funds that they put their money into.
Yeah, I believe it. The one I used to know was that people spend more time planning their vacation than planning their financial future, right? And that's egregious. But anyway, and that's exactly what we're doing today. And we're talking about this number 6 of the 10 items that we're going down here is mutual funds. And how mutual funds are the disease of ease, double dipping for fees.
Yeah. Yeah, that's the other part we didn't talk about, right? The fees inside of those.
Right.
But like you said with Greg, he told those investors it's that easy. It's easy a check mark, because that's what you do to buy a bond fund. You just check a check mark on your trading platform. Boom, you bought it. You don't have to do any individual research. We have to hire an entire team of people to go through and look at all the companies that we want, so we can find these ones that are trading at a discount but have good fundamentals to back them up. It's not like you could just look at a screen and say, oh, look at this past performance, check this, right? We have to look at all the income. We have to look at their assets. We have to look at their credit worthiness. We have to look at everything, not just like, oh, that has an A next to it, that's good to buy, right? We look at
Yeah. What it reminds me of, when people hire a financial person and the financial person puts them in mutual funds, it reminds me of the idea of who in their right mind would go and hire somebody to find a mechanic to work on their car. There's not very many people, at least not the everyday Joe. Maybe there's rich people that do that, right? But that's kind of what it is paying somebody to find you a fund manager. Now, that's kind of crazy, because you got to pay both people, and that's where the double dipping comes in, because the person who you're paying to find them, yes, might call your advisor, is making a fee, and then they're also you're also paying the mutual fund a fee. It's internal. You don't see it, but it's in that prospectus that you get every year. Daniel, there's a big name company here on our road here that in Guilford that I've seen people's accounts from there, and all in, these people are paying 2%. They're paying the advisor like 1.25%, but then the mutual funds are taking 0.5 or 0.75%. So it's like 2%. That's humongous. That's terrible. Because it was one thing if you're making 14% and they're taking 2, and so now you're only making 12. Let's say if it's that high, right? But if the market's down 10% and they're taking 2, now you're down 12%, and that's hard to make up.
That's really hard to make up. And you hear people say sometimes, well, I'm not planning to take any money out. So this reverse dollar cost averaging stuff you're talking about doesn't really apply to me. But if you have to take RMDs, or we've seen products, right? Wall Street products that have 3 and 4.5% internal fees. So you're not taking any money out, but somebody is.
Exactly. And, the disease of ease is so easy to choose mutual funds. But the big thing is, who's watching shop. I mean, a lot of people, Daniel, you've talked about how like the S&P 500 is, people will choose the index fund, S&P 500, because it's a long, steady fund, right? But they don't know about those companies that are in there that are kind of like zombie companies that, who knows, with this fallout that we're having right now, where the S&P is down close to 20% from the beginning of the year, maybe some of these actually zombie companies are actually going to be going out of business. So there's another issue that comes along with bond funds, right? I mean, with with mutual funds.
Yeah. Yeah. And in a crazy market like this, you want to know what you're owning. And in credit in general, you want to know what you're owning, because you want to make sure that company is generating enough cash flows to cover the money they promised you, and then they're able to give you back your money. Because if not, then it doesn't make any sense to do that. And it's also funny because people will talk about credit is bad, right? Bonds is bad because, like, what happens if the company goes bankrupt? But it's like, you call that junk or you call that bad, but then if you're in equity, that means you're double junk or you're double bad because it goes credit equity. So, but the point is, I could get that if you're talking about a fund, because you don't know what you're getting inside the fund. Right. Whereas if you have the tools, you have the team to do the individual due diligence on each company.
Yeah.
Then you're not like, well, this company's trading at a discount, that must mean it's bad. You're saying, look at how this company has changed and look at these cash flows, and the S&P rating hasn't changed yet, or this hasn't changed, or people don't see this, and you're finding mispriced things. It's kind of like treasure hunting, right? We call ourselves treasure hunters sometimes because that's what we're trying to do. And all of this goes back to respecting people's capital. Respecting people's savings, right? Because an investor didn't save up this money so that they could pay it out in fees, or so that they could hope that they can retire. It's saved up so that they can support the lifestyle that they want to have in their retirement. And you have to respect the person, the investor, the individual, the face, right? The face, this person, not an account number or this or that, or it's just a bunch of accounts that we take fees out of, right? You see that face of the person that's retiring.
Right. Exactly. And that's where, this mutual funds a lot of times are just an easy thing to do. It's not necessarily, could be very suitable for people, but not necessarily in their best interest. So that is key there. Well, listen, if you're just joining us, you're listening to Financial Strategies with Andrew, Daniel, Ajmi, and today's topic is retirement confidence. You have it. And we want you to from that standpoint. You might be thinking, well, if mutual funds are so bad, what do we have to invest in? Well, we have a paper that we'd like to give you that be able to help you understand that a little bit better. It's called The Universe of the Universe of Income Generating Investments. And so we'd love to be able to put that into your hands, to be able to read, to see what there is besides the bank and besides the stock market. Not that we're against the stock market, but right now the stock market is down 20%. Is it a good time to buy? Well, who knows? Maybe it's going to go to 40%. And if you buy at 20, that's not good, a negative 40. So anyway, you can have by calling 800-725-7616, and we'll be glad to put that in your hand. Daniel, when we're talking about the disease of ease here in mutual funds, and the fees are horrendous from that angle, and it's all part of Wall Street's plan, right? Wall Street's perspective is that you're always hearing from Wall Street is time in the market It's not timing the market kind of thing. And, Wall Street gets paid when the market goes up, when the market goes down, and when the market goes sideways. But, the individual investor, especially retail investor, usually only gets paid when the market goes up. So right now they're actually losing money if they're invested in the indexes in the market, because the indexes are down right now. But this can present a huge problem. Wall Street's model, right?
Yeah, the Wall Street model, right, is Wall Street gets paid, and if the investor gets paid, then that's good.
If
it's not a charity. They're not working for you. They're working for the companies,
right,
that they work for. So example is, we talk about these structured products sometimes, because what these structured products are, they're good ideas. So like, if all these things happen, you can make this money and keep your principal. If this unlikely event happens, then your principal is gone and you didn't make anything. And it's wrapped in this basket, in this shell with a bunch of fees inside of it. And we've seen these so many times. People come into our office with these in their accounts because it sounded good. It sells good, right?
Sounds good.
Cool name. It's a
good idea.
They don't understand what they have.
Right.
And usually what ends up happening is they just don't make anything. So it's locked up for X amount of time and they just don't make anything. And they throw it off to, experience or something like that. But these products are designed so that the people building them make money. And then if you make money, then that's good too. But it's not designed to make you money. It's designed so that they can make money and then you do. But then what also they're designed to do, and this is the really egregious part, because what they are designed to do is take the liability off the Wall Street firm's balance sheet and put it onto your balance sheet. So there's this thing called VAR, and we got to go into break, but there's this thing called VAR. And basically what it means is there's a probability that this shock will not happen. But if that shock happens, everything goes crazy, right? And so if that happens, they don't lose any money. All the risk transfers to the investor, and the investor doesn't know that. The advisor selling that thing probably doesn't even know that. But these are really egregious things, these structured products that get pushed into people's accounts that nobody knows how they work unless, they have training in how these things work.
Yeah, they typically don't make money for anybody except the people that structure the products, right? Well, yeah. So, exactly. So, we're going to need to go to break. But before we do, we want to offer you the book that's going to be able to help you to understand the aspects of today's show, Retirement Confidence. Do you have it? Well, this book, Retirement Income Story, will be able to help you be able to understand how you can have more confidence, or be able to understand why you shouldn't have confidence in your existing plan. We'd love to be able to put this into play for you and to send this to you. You can have it by calling for free. No obligation, 800-725-7616, 800-725-7616. Ask for the book, and we'll be glad to get it to you. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Adjemy in Connecticut and Daniel Adjemy in Colorado.
Daniel, I got a kick out of that when you say, these structured products that you're just talking about are good ideas. That reminds me of a story that, they talked about regarding Newt Gingrich, right? And there would be a stack on his desk of, it said Newt's ideas, and about 2 feet tall. Right. But then there's another stack right next to it that's about a half-inch tall that says Newt's good ideas. So there's a huge difference between ideas and good ideas. Ideas, real world knowledge ideas as well, and textbook knowledge ideas. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Yeah, Dad, that's probably the political way, the diplomatic way of saying it. The tinfoil hat way of saying it was they were good ideas, but they were designed for the firm selling them, right? And they knew exactly what they were doing when they put it together.
Right. Exactly. And, so Wall Street, they make money when the market's going up, when the market's going down, the market's going sideways. That Wall Street, so their methodology is one that they want your money in the market for as long as possible. So you hear things like, over the long term, the market goes up over the long term. But a lot of the people, Daniel, in our listening audience, right, the long term's behind them, not in front of them.
Well, that's where it goes back to one of those first ones, listening, right? So a good way of explaining communication would be, first you need to understand and then be understood.
Right.
So a lot of salespeople want you to understand them. Understand me. This is what I have. This is what I got for you. This is what I'm selling. This is how this works, right? So how can you get somebody in the right thing? So for some people's money, the long term is good because they're looking at 100 years, right?
Right.
Not for them, but they have enough money that they want their kids, or whatever to get the money. And they're not going to sell. They're not going to get freaked out. But if you saved up $1 million, that's a good amount to retire on. That's what most people need. Now, everybody's situation is different.
Yeah.
And if you invest that just right, it won't be a hope strategy. You'll be on target. You'll know what you're generating income. You know what you can spend, and you know where you will be in X amount of years.
Right.
But people have emotions and people have feelings and people have different things. So you can't say, well, this strategy, if we look back 100 years, this works. If you don't ever sell when you get scared and you never need any money in a down market and there's no fees, and that time you wanted to help your kid go to school in a down market, you can't do that, right? These kinds of things are not equated into these assumptions. People want to live. You didn't save up your money so that you can watch it in an account, right? You saved up your money to trade it in for lifestyle chips,
right?
And that's living, right?
Right.
And there's this thing people are really worried about, right? Inflation. And what's the key to beating inflation? Keeping up with your purchasing power, right? It doesn't matter. Like the dollars in your account don't matter as much as your purchasing power, because if we have inflation, why do you care? Why do people care about inflation? Because they want to buy things. And now their money is not buying them as many things for the same money. So it's not about how many dollars you have. It's about how many things you can buy. Right.
Right.
And so if you can keep your purchasing power more than inflation, inflation's not hurting you.
Right.
And that's what people miss. It's purchasing power. That's what you need. Exactly. That's what you need to have a successful retirement. That's what true income specialists understand and know how to generate, right? Exactly. The purchasing power.
And it's about the income. It's about the income, right, Daniel? That's what you're talking about. It's not about the size of your account. It's about the income your account is generating. Earlier, you talking about how we looked at those people's accounts, that their accounts were generating dividends and interest, but that was only enough to cover the fees. And so that's really not generating dividends and interest for themselves.
There's no purchasing power, right?
There's no purchasing power.
Unless
they have to sell.
The accounts go up. Yeah,
exactly. And they have to sell investments in order to do that. They're not living off the interest and dividends. And that's where the problem comes into play. Like you say, do you want to put off sending your kid to college because it's a down market? Do you want to put off buying a car? Do you want to put off retirement because it's down market? That's what people had to do in 2008, 2009, because they made that vital mistake that so many retirees make. They didn't switch from the accumulation stage to the distribution stage at the proper time. And the distribution stage is the income stage. Now, many times what professional financial people do is they do what's called engineering income by the withdrawal method. And that's what people typically think about when they think of their bank accounts, withdrawing money. That's not what income is. That's not what we're talking about. But, to help you in our listening audience understand more what we're talking about, we put together a paper. It's called The Dangers of Spending Down Principal During Your Retirement. And in this paper, it describes, the way to be able to take income out properly as opposed to withdrawal method, the engineering method. And we love to put this into your hand. It's called Spending Down Principal in Your Retirement. You can have that by calling 800-725-7616. It's free of charge. Call now for that. You're listening to Financial Strategies with Andrew Daniel Adjemi, because people don't know what people don't know. Today's topic is retirement confidence. Do you have it? You got somebody that you got an income specialist that can help you have it? Well, that's what we're talking about today. And we're running down the list here.
So I think we beat up Wall Street enough, right? We went on a big enough rant on that. The two things people need to watch out for: check those fees, right? Ask what the internal fees are, ask what you're being managed. If you don't know how much you're paying, you got to figure that out. So ask whoever's managing your money, or if you're managing, what's the internal fees and what are the other fees? If it's over 1%, right? If it's over 1.25%, you're paying too much.
Yeah.
And that's
especially
including
if there's mutual
both.
funds.
Right. You got to get the internal fees, because if they say, well, we charge you 75 basis points or we charge you 1%, right. Well, what are the internal fees? Right. The other is, some of you people know when we talked about those structured products, some people listening don't know them by the name structured product, but you have that in your account. You say, oh yeah, I remember always asking, why is this thing not doing anything? Why is this thing? They told me it's supposed to, I'm supposed to get coupon payments, but it's got 0% on it and it hasn't done anything. You got one of those. You need to figure out if it's worth getting rid of that, and if your principal is at risk if certain things happen.
Right.
But now we covered those. Let's talk about one of your favorite topics. Taxes. Yeah.
Well, yeah. Well, if it's tax free, it's for me, right? I want to pay as little taxes as possible. And, taxes are very important. Taxes are on sale right now. 2025 tax rates are going to go up. And if you and our listening audience are married, well, when one of you passes away, your taxes are going to go up again, because you're going to go from a married filing jointly status to a single status. And then your rates will be increased at there. So it's important to be able to get the most bang for your buck when you can. When is $1,000, Daniel? Not $1,000.
You got to give part of it to somebody else.
When you have to pay taxes on it. Exactly. So
that's another way, right, to increase your purchasing power. We talk about inflation. People aren't worried about inflation. People are worried about their money not buying as many things. Right. Why do we save money? We don't save because we like having little green dollars. Right. Little green bills. We save so we can have more consumption in the future, and inflation erodes that. But if you have tax-free money, then what does that do? That gives you more purchasing power.
Yeah. And this is one of the things that, when I'm talking to people and doing reviews with people these days, they ask me two questions. How is my money faring in regard to the stock market? And typically, where the stock market is down double digit, if our clients are down, they're down maybe 1 or 2% or something in that vicinity. But the biggest aspect is their income, their purchasing power is increased, and anywhere from, I've seen 4% to 30% increase over the past year. That's a great increase. That's a great, cost of living adjustment that's been given to their retirement monies. That's phenomenal. But then the other way that we do that is by talking to people about paying the taxes now while they're on sale, because you're going to have to pay the taxes. The question is, at what rate? We'll pay them now at a cheaper rate, and then be able to get that money in the future tax free. To be That's a beautiful thing. Tax free. It's for me. And then there's other aspects where people have it. I mean, that's talking about the 401k, the IRA that they can convert to Roth, right, Daniel? But there's there's a lot of people out there that have a lot of money that's not IRA or Roth IRA money. It's after tax money. They're paying taxes as it grows. They pay taxes as taking money out, all these things. There's ability to be able to set that money up on a tax-free basis if they have the right kind of person helping them, an income specialist, a person that can help them to give the money tax-free.
Yeah. And the taxes eat up. So interest rates are already, right? I mean, you got 1% at your bank, you're thrilled.
What was that again? Say that again.
If you had a 1% interest rate at your bank, you'd be thrilled to death. Yeah.
Yeah. Oh, yeah.
And so you've got money sitting in the bank. And if you got 1%, it means it's getting eaten up right now by about 7% a year. So you're losing 7% a year basically in purchasing power because of what inflation's doing. This is where people get scared, right?
Right.
But you're earning 1%. That's pretty good.
Yeah.
And then you realize, wait a second, I'm paying about 40% taxes between all these different things, depending what bracket you're in. That means I didn't earn 1%. I only earned 0.6, 60 basis points.
Ouch.
And so some of the things you're talking about not only are generating higher rates and giving you other benefits, right?
Yeah.
Like maybe there's something like an enhanced death benefit, or there's something to help you with long-term care or things like this. But it's also either tax-free or tax-deferred, depending how you use it.
Right.
So if you're earning 4%, it could be 4%, not 4% minus the tax rate minus, right? The state tax 2%. Rate minus,
right.
Subtracted from Social Security, subtracted from.
Yeah. Right. Exactly. And, you're getting 3 or 4% tax free. It's, you'd have to get 5-6% taxable to end up with 3 or 4% after tax. But you're exactly right, Danny. There are different things. And if you and our listening audience, you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is retirement confidence. Do you have it? Working with a true income specialist can help you to have that. And we have a book today that we'd like to give you to be able to help you understand these things in a little bit more clearer way or in more extensive ways, called the Retirement Income Story by our friend David Scranton, with a lot of alphabet soup after his name. But the point is, it's an easy read book that be able to give you some insight into things that you have not thought about before, things that will help you have the questions to be able to ask, or perhaps the answers to your current questions. You can have this for free, no obligation, by calling us at 800-725-7616 to ask for your free copy. Just ask for the book, 800-725-7616, or hit us up on the web at agemy.com, AGEMY.com. The 2 words AGEMY spell our last name of Adjemi. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
Truthfully, I was doing a review with somebody the other day, and we looked at the income, and their income was up. And he said, how is the income up? And when we say income, we're talking about what the accounts are generating, right, on a either guaranteed or promised basis. How are they up? 2 of the accounts weren't up. One of the account was down a tiny bit, and one of the accounts was up substantially. His 401k is down 25% or something like that. How is this up? And I explained to him, the goal, right? The goal in retirement is that you have enough income to support the lifestyle you want to have. And you can't control what markets do, but that means you shouldn't make nothing and have no increase in purchasing power. And he was like, yeah, that's exactly. He hadn't thought of it that way. He knew that's what he wanted, but he didn't know that was possible, where you can have more purchasing power, even though your accounts may not be up.
Right.
I'm Daniel Adjemi.
And I'm Andrew Adjemi, and you're listening to Financial Strategies, because people don't know what people don't know. And today's topic is retirement confidence. Do you have it? Well, we've been running down the list of the various things to that ways that people can have it. And Daniel, what you're talking about, that the increase in income, that's a huge thing. Sometimes people don't. We've talked about three-legged, four-legged stool of retirement, right? With a pension, Social Security, and then a retirement savings. That's three legs. And sometimes people have like maybe rental incomes that they're getting. So that might be a fourth leg or some other source from that. But, there's a lot of people today that there are some people that have pensions, but there are a lot of people that don't have pensions. And that is a way that people can design their own pensions that don't have them, and they don't realize it, because that's an income that they can't outlive, just like Social Security, right?
Yeah, exactly. Actually, in this same review, the guy wasn't happy with the pension that his company is going to offer him in the future. And I said, you could build your own and you could see which numbers come out better. And he said, you can build your own pension? Yeah, you can always compete. If your company is giving you a buyout opportunity or a pension opportunity, see if you can get better promises, right? Better guarantees, better income numbers than what they're offering you, because it is possible. It doesn't always work out that way, but you got to do the due diligence, just like you would on your dryer, right? If you were buying a dryer, you're going on vacation.
Yeah, exactly. That reminds me of the check that we got this week for well over $1 million from somebody's pension. He decided that the pension at the company wasn't going to be in his best interest. He's kind of disinheriting his kids from that. He's married and has kids. And, if they both died and he had the pension, well, there'd be nothing left for the kids. Well, this way here, he took the money and he's going to create his own pension plan so that if he dies, his wife still gets something. And when, they both are passed away, the kids get what's left over from that. So it's really a great opportunity. And you can, that's what he saw it as, because he's still going to be guaranteed the income, but instead of that company that's guaranteeing the income, it's a strong insured company that's guaranteeing the income from that standpoint. So it's a great opportunity that people have. And so many times people don't even know they have it available to them, right? But a true income specialist is going to be able to help them understand what's available. Right. And compare it and do the due diligence.
These are conversations a true income specialist would be having based on that, on listening to the goals. So if the goals is to pass money on, then the pension would be designed differently so that you could get tax-free money that passes on to your family members, compared to you used to have a lump sum and now it disappeared, but you get a payment as long as you're alive, right? There's different things, but that's what a true income specialist understands and knows how to design.
Exactly. And, it's a lot of people in our audience, Daniel, might be wondering how we do what we do. And we badmouth certain things like mutual funds and bond mutual funds, because that's not typically
and Wall Street,
right? Because it doesn't respect people's principle. They worked hard. The people's money is a representation of their life, right? Because their career, they spent their life working and earning money, saving money in order to they can have a time to cash in that money for those what did you call them, those lifestyle chips, right, to be able to use in their life. And so their money represents that, so it needs to be respected. And how you deal with that money, you need to have everything in your toolbox, right? You don't want a carpenter to come fix the leak in your house. You want a plumber come fix the leak in your house, because the plumber has different tools in his toolbox than a carpenter has. And so with that, we have different tools in our toolbox than what most professional financial people have. And one of the papers that we have for you today in our listening audience is the universe of income generating investments. There's a lot of different things out there that can help you, that can lower your risk, but still make sure that you get the income, you get the dividends, you get the interest that you need. It can be guaranteed, it can be promised, but staying away from the hope side of things. And we love to put this paper in your hand, the universe of income generating investments. And you can have that by calling 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Adjemi, because people don't know. What people don't know in today's topic is retirement confidence. Do you have it? Daniel, as we finish up here, we just got a few minutes left in this show this week, and this is part 2 of a series. And I'm going to wrap up, I think, in going through the various things that we've been talking about. But what do you have to say before we do that?
We did this show so that investors can re-look at their portfolios. Year to date, people's portfolios have been tested. They've been battle tested, give you a taste of what could happen, right? And if it hasn't performed, if it hasn't held up, you're not happy with that. You got to start asking these questions. It's not generating more income or more purchasing power than what the fees are. You got to start asking questions. Now, you can advise your advisor, and some people like to do that, or you can find someone who can be a CEO, or you are the CEO, right? And you find someone who is your CFO of your finances and brings you the ideas, and you make the decision. I like that. I don't like that. Let's do this. Let's do that. But that's what you need to have a proper retirement, to have a CFO of your finances to help you, bring you the ideas so you can make the decisions. I think that's really important for people to understand. And that's why we put this show. Hopefully these are some ideas, some things people don't know in their portfolios. We have beat up Wall Street maybe in this one. And that is because we respect investors' capital. They worked hard for that money.
Yeah.
And they deserve the best. And if someone's not giving them the best, then we want to tell them about that and let them make the decision. That's our job. There's a lot of people like us who have given up their Series 7, given up their stockbroker licenses, because this was something that is designed to sell these kinds of things. And you give that up and you get a advisory license, one that's designed so your incentives are lined up with the person you work for. And now you don't work for a Wall Street firm who pays you, you work for the client. And so there's people like us who have given up those things so that they are in line with the client. You got to find somebody like that.
Exactly. Good. Well spoken, Dan. Another thing I think of when you're talking about that is just, you're not as young as some professional financial people today, but, it's important to be able to have seen and been through and weathered the storms that the stock market has brought about in 2000, 2008. People need to be in the business for decades to be able to understand the good times and the bad times, because you want you and our listening audience, I think you want somebody with experience, somebody that can help you through, that has been there. Hey, don't worry, I've been here before. Don't worry about this. We can get through like this, as opposed to somebody that is just, been in a bull market for their entire career. Right. And the other aspect is if they've been in finance, well, that's one thing. But how does it affect retirement? They need to be able to help people retire every day for decades in order to be understanding how to help you to stay retired, to retire and stay retired. Well, the things as we wrap up here, we needed to finish up. We're wrapping up. And the things that we talked about was, first of all, listening. Number one was listening. Number two was being a fiduciary, as Daniel was just talking about, a true fiduciary. The third thing was we talked about Social Security and required minimum distributions, and that the person that you need to be able to have these under your belt and understand how they work. Bonds versus bond funds, they are two different things. Respecting people's capital because you worked hard for it and it represents your life's work. Mutual funds, the disease of ease, and double dipping for fees. Along with that, we talked about Wall Street and the timing of the market and the time in the market. They want you to keep your money in the market for as long as possible so that they can make as much as possible from it. And the eighth thing was, it's about the income, making sure that you have the income that's going to last the rest of your life. Tax-free is for me. The taxes are a huge part to make sure that the taxes are handled properly. You pay as little tax as legally possible. And then building your own pension plan, an income that can last the rest of your life, having to call or add it to your cost of living adjustment from that angle. All these things are things that can help you to have retirement confidence, especially if you have a CFO that's guiding you along that way, whoever that may be. Well, listen, we're so glad that you allowed us time this week to be able to explain these things to you. We trust that you are understanding things in a different way than you had before, and understand some questions now that you didn't have previously that you can ask your financial person, or at least maybe have some answers. But we'd love to give you this book as a parting gift for today's show, Retirement Income Story by David Scranton. And this book will be able to give you some insights as far as preparing for retirement, whether you're in retirement or you're 10 years before retirement. This will give you some insights that you are not going to get elsewhere, because there's very few people that are income specialists these days, true income specialists. So we'd love to put this book in your hand. You can have it for free by calling 800-725-7616, or contacting us on the web, agemy.com, agemy.com. If you missed last week's section, part one of Retirement Confidence, you can check us out anywhere that you listen to podcasts by searching for Financial Strategies with Andrew and Daniel Agemy. Well, we appreciate you joining us today, and you too can have a stress-free retirement.